Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Scenario one, could money also flow to gold, not oil, impacting U.S. dollar, Australian dollar, and the rand? Yes, it could. And what's interesting is the correlation between gold and the dollar has broken down a bit in the last several months, where it used to be extremely tight in almost every time frame you looked. But if you go back and look at gold, we've had several weeks at a time which the dollar was going up and gold was going up during that risk-averse move. That tells us something, because let me just step back real quick. The dollar and gold tend to be mirror images, seesaw, because gold. Think of gold as your world reserve purchasing currency, in effect, the real stuff. Gold is priced in dollars, and gold is your valuation against real stuff across all borders. So if the price of real stuff goes up and the world reserve currency is going down in price, and gold is priced in the world reserve currency, therefore gold prices have to go up. Rarely do you see the dollar moving up and gold moving up at the same time. When we saw that, it suggested to us, at least at the time, that maybe some money was really getting scared out there, especially in Europe, given what was going on, and we had in the height of concern of what was going on in the Eastern European banking system. We think some of the deeper European money was moving into gold, plus dollar was getting the risk bit at the same time. So we have to be careful with that correlation in here. We could see that correlation break down again, but there's no doubt gold in general has been a mirror image. We think ultimately, again, I'll beat that information that I just said about the breakdown in the correlation, and gold and the dollar actually going the same way. Ultimately, if you step back and look at a long-term basis, a long-term chart of the U.S. dollar index, since it started floating back in 1971, floating, which means it started being priced on supply and demand against the world major currencies, every major bull market in the dollar was met with a fairly significant bear market in gold. We happen to be bearish on gold for that reason, because our longer-term view in the dollar is we are in the start of a longer-term bull market in the dollar. So there's where gold fits into that scenario. We see the world reserve currency gaining value again, and if so, the price of gold will generally fall. We happen to also think over the near term, 6 to 8 months, that we could be in a deflationary problem in the world, which would generally helps the world reserve currency. Deflationary situations tend to help the world reserve currency, and we don't think that will be necessarily good for gold in this environment. One more question. M1 goes up. We've seen big moves in money supply in a very, very big way. But what's really interesting is this money is still sitting in the vaults of banks out there. They're not lending. Two reasons why the stimulus has not really stimulated. Number one, the banks are sitting on a massive amount of reserves they don't want to lend. They want to save themselves, which they're doing. They're tightening lending standards all around, even though they have plenty of money. Number two, the U.S. consumer is saving, and he's not buying anymore. When he's not buying, it means the velocity of money falls. So you can pump up that money supply all you want. If the U.S. consumer goes into a shell, what's called the velocity of money falls, so it doesn't have the stimulative impact on the economy or prices. So we're seeing both that reserve buildup on the commercial bank side, and we're seeing that massive decline of velocity of money, which means all this money being thrown into the market isn't getting into the real economy. And that's another reason why we don't think we're going to see inflation for a while, and deflation is the real problem going forward. I think that's it, Lynette. Thank you, and thank you, everybody. I appreciate all your time today.
It was really an excellent session, very informative. Jack's webinar will be available in our archives tomorrow on ise.com/archives. And, and he's also going to be presenting next week next Thursday, so definitely look for that in our webinar schedule on isc.com/webinars. So feel free to send us any questions you have, additional questions you have that we didn't get to, webinars@isc.com or the info@Black Swan Trading.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.